Hi everyone, welcome back to chapter 5. I hope you had a good understanding on the chapter 4, which is cash and internal control. So chapter 5, I wanted to say it's a little bit, it's not hard. I wanted to clarify that, but it has a lot of content, meaning that we have a lot to cover. So I just wanted to kind of break down to tell you a little bit about what the content we're going to cover for this chapter. So first of all, we want to in detail introduce what is a credit sale, right? And then we're going to talk about uh, trade sale, trade discounts, and sell discounts, sell allowances, and sales return. And then that's going to be one video. And the second video, we're going to talk about receivables. So if you are looking for to learn, just look at the receivable video, then starting with the second one, okay? Within that, we want to talk an estimation of uncollectible accounts, write off the AR when it's actually uncollectible. And then we can talk about collection of accounts receivable, how do you adjusting those entries. And then we want to talk about aging of the accounts receivable and the direct versus allowances method. And third portion of it, I think we talk a little bit about it in chapter 3. So if you didn't have a clear understanding of that, that's a good time to catch up. Note receivable, and we majorly learn how to creating the notes when you have lending money to other people, and then how to record interest income, right? Interest revenue. And then the last one is going to talk about evaluating the health and the effectiveness of the company to collecting the receivables. So in one word, this chapter is about how does the company deal with accounts receivable, meaning that the money that they're supposed to collect now, but they didn't, and it give people more time to pay them back. So receivables. Okay. So without further ado, let's start looking at the content for the first part. Okay. So we said the first part is gonna be credit sale, right? What is credit sales? Second part, we're gonna teach how about what is the receivable. And most important thing, how to record uncollectible amount, uncollectible receivables. It's the second video, and then including write off the receivables, including aging method versus straight line allowances, straight line percentage, right? And then we compare direct write-off versus allowance method. Okay. And then third part that we're going to create in the video is called a note receivable. And we also going to talk about ratio analysis of accounts receivables. And at most, we're adding a little bit credit sale allowances. Right? So that's it. So so major heavy lifting is on this one. So and then probably most problem solving is in this one. Okay. And I'm gonna go through every piece of the slide with you on this chapter. Okay. Okay. Let's see. So recognizing what is the accounts receivable. So basically, we want to recognize the accounts receivable at the time we made the sales, right? So when the company transfer products and services to the customer today, and the customer today didn't pay the company yet. Hence, the company expected to collect in cash in the future. If the essence of the transaction is like this, then that means we made a credit sale. We also call it a sales on account or service on account. Remember on the chapter 1 to chapter 3, the exam, everybody is confused. What is on account? What is on account? But on account meant the money is not arriving at the same time as the event, as a transaction. Hence, the sales on account or service on account is actually implying that the customer is paying us in the future. Okay, and it's very common for many business, right? And credit sales, including an informal kind of credit agreement supported by an invoice, right? So we need to have an invoice, and is a source document to identify the date of the sale, and also the customer, who is the customer that's gonna pay us, and the specific item sold and dollar amount, right? So what is being sold and how much, what is the invoices, date, what are being sold, who did you sell to, who is the customer, how much, right? Payment terms typically requires the customer to pay in 30 days. So basically, you need to pay everything you owed within 30 days. But if you actually fail to do so, there will be a penalty. But if you are paying ahead of 30 days, within 30 days, there could be some discount or rewards of paying faster, right? Okay. But sometimes you can extend into 60 days as well. It's not that it has to be 30 days. So even though no cash is received at the point of time that you make the sales, the sellers record revenue immediately. Hence that we normally report debit, accounts receivable, credit, revenue, right? This is a chapter 2 content, right? We learned there. Okay, so I just want to give a little bit of overview. Okay, cash ordered to the company by its customer from sales or service on account is called accounts receivable, and recorded at the time of the sale or services, and also is called a trade receivables. Let's record one credit sale. Okay, on March 1st, a company provided service to customer for 500, so they already provided the services. That's the key. And the customer does not pay cash at the time of the service, but instead promised to pay the 500 by March 31st. So March 1st, they're already providing services for 500, but they didn't get it paid. So immediately on March 1st, what do? We will debit 500 accounts receivable, and we credit service revenue for 500 at the point of sale. Okay. The company records the following transactions at the service or sales. Okay, so the key points to take away pretty much is understanding what's accounts receivable. In nutshell, it means that you provided services, you made money, but the people haven't paid you yet. So company will record an asset account. So apparently account receivable is an asset account, okay? And a revenue is basically equity account, right? So it's increase here and increase here when you do the transaction. Expecting to collecting the cash in the future. Once receivable is collected, the balance of accounts receivable need to reduce. So March 1st, you created this transaction. Say March 31st, the person who actually used 30 days to pay you. So say you debit 500 March 1st, and then March 31st, that person paid you 500. Hence, this person should owe you zeros. So when people pay, when customer pays you, pay you cash, right? Pay your cash related to what they owe, you should reduce or credit accounts receivable. Okay. And another type, there's all kinds of receivables. There's other kinds of receivables, such as non-trade related. So what we just talked about is commerce related, such as buying and sell or providing services. There is also non-trade receivables, such as that originated the source other than the customers, right? For example, interest receivable. If you lend some, your lender lend money to some other people. So that is receivable. That's a receivable to you that you're going to receive principal and interest in the future. Hence, this we call the interest receivable, right? So you lend money to your friend for say $10,000. You say, well, you can give me principal $10,000 back, but I will charge you 2% interest. So that interest is considered your revenue. At the same time, that interest that you haven't received until next year called interest receivable. Okay. And loans by the company to other entities, right? Sometimes a company conducting investments, such as they consider other company have a higher have a reliability of pay the loans, so they're willing to loan other company money, such as their subsidiary, at a certain amount of the rate, like interest rate, right? Like on sometimes even more simpler, like stockholder can borrow money from the company or even employees. Okay, so there's another thing besides accounts receivable. It's called a note receivable. In essence, it's a formal credit arrangement evidenced by a written debt instrument. So what does that mean? Means the money you lending to that person writes you a debt contract, okay? And then there's a note receivable name here. And we're going to talk in details the who owes you for how much, at what rate, at what percentage, and when they're gonna pay you, okay? And then they have a signature here. So this is a note receivable to you, meaning the company lend money to outsiders. So this is called a formal credit arrangement with a written debt instrument. This is a debt instrument, okay? Okay, so let's do a concept check. Which of following generally is reported at the time of company providing service to customer on account? Whenever we see on account, this is the keywords, okay? Keywords to indicate that we are talking about receivables, right? So of course, it's gonna be accounts receivable, right? Accounts receivable, sometimes called a trade receivable, representing cash owed to the company by its customer from sales or services on account. No trade-related receivables, including tax refund claims, interest receivables, loans by the company to other entities. Okay. So now we wanted to talk about how do we understand how much net revenue we really made, because there's a times that companies actually will offer say sales discounts or a sales return allowances. So we need to consider all this scenario to be able to understanding how much sales there is really made, okay? So trade discount, okay, remember the name is called trade discount. Trade discount representing a reduction in listed price. So say the listed price is $300, and then it meant reduction or reduce the listed price. Okay. So and companies typically use a trade discount to provide incentive for larger customer or bulk purchases. And the trade discount also can be a way to changing price. In other words, trade discount already changing the price of the product, okay? And without publishing new price list or disguise real price from the competitors. So let's see. And so when we record the trade discount, we are recognized by recording revenue for the lower amount. So I wanted to tell you, this is the key of the key. So so we are recognized by recording revenue for the lower amount, meaning that the original price. So let's look at this. The typical price for the eye surgery is $3,000. Eye doctor run a special for $2,400 by offering trade discount. Okay, trade discount for $600. So in other words, the eye doctor will only record $2,400 as revenue. Okay, so because eye doctor haven't been able to collecting the money yet, but he already performed the surgery, let's say, so therefore he will put the accounts receivable for only $2,400 and the service revenue for $2,400. Okay. Okay. So okay, and then let's look at the sales return and versus sales allowances. And customers sometimes are dissatisfied with the product or services. They are allowed and they are entitled to return the products or getting allowance from the store or from the service entity, right? So then what's the difference between sales return and sales allowance? Sales return means that the customer did return the products previously purchased. However, sales allowance means that customer does not return the product. Okay, and in terms of sales return, sellers usually issue a cash refund if original sales was for cash. So, for example, this is usually what we are actually have an experience with, right? So, if we buy something from say TJ Maxx and we want to return it, we hold the product and don't cut the tag, and at the same time we're presenting them with the receipt. Immediately they will ask you, the store representative does ask you, and did you purchase by cash or credit card? And then if you say I purchased by cash, they can immediately refund you the cash. So this we have a life experience about, right? And then B is a seller reduced balance of account receivable if original sales was on account. Okay. So if, for example, you bought $10,000 products, but only partially of that products that you want to return, hence that once you told the seller, which is the company, that you want to return partial of the product you received, the company, you are the company, immediately write down the accounts receivable. Okay, immediately reduce the balance of the accounts receivable. Okay, on the if you are doing sales allowances, that means that the seller will issue a cash refund if original sale was for cash. Same thing, everything's the same. And also, sellers will also can reduce the balance of accounts receivable if original sales was on account. So if an original sales is debit, accounts receivable, credit, revenue, because you feel that you are not satisfied with these services, of course you cannot return the services, but your excuse or your reasoning is legitimate. Then the store agrees to give you allowance. That means that the store is gonna write down or not write down or reduce your accounts receivable immediately by recognized sales allowance. Okay, we're gonna look at the specific examples. Okay, so for example, the customer returned the eyelaces purchased for $200 on March 2nd. So on March 2nd, of course, it's already had another sale, right? Accounts receivable and the revenue for $200. They bought some eyeglasses, eyeglasses. But however, they are not happy about something about them. So therefore, they wanted to return their glasses. So sales return is a contra revenue account. We talk about the contra account, right? Contra means reduce or against, right? A contra revenue account, I wanted to highlight this very dearly. So, sorry. So contra revenue account, what does that mean? Contra revenue account is account with balance that opposite or contra of that of related revenue account. Okay, the reason that we use the control account is to keep record of what have been original sale and what has been returned, right? It's a little bit like the concept of the depreciation. I know a lot of you guys have the problem, but I think this is a good time we review a little bit. So so basically, if we had a sale for 200 as a revenue, right? So let's see, that's a set of a revenue account for 200 on March 31st. Okay, and then because you set up a control revenue account, meaning that you are admitting the sales was not successful, hence that you will put, instead of write down this 200 right here, you put called sales return, and you put a 200 here. And then the relationship between these two is that revenue is always have a right-hand side balance, and sales return account is always has a debit side balance. Hence that sales return account is a contra or reduced revenue account. So when you write down on the income statement, the revenue account will be say 200 here, and sales return is going to be 200 here. It's right under him. Hence that you know your net sales in terms of this transaction is 0, right? So therefore, let's first learn, if you are aware that the customer returned the $200 eyeglasses purchased on March 2nd, what's gonna happen? You debit sales return and you credit accounts receivable for 200. And this transaction reduces the revenue and the current assets, right? Because this is the what minus asset, right? And this is minus equity, right? Okay. So same thing with the sales allowances. Sales allowances, the only difference is that you do not need to return products. Right? Usually it's a consumption of certain kind of services that you cannot return. So customer receive a reduced price on the eye surgery because she is not satisfied with the result. Oh my God, that's scary, right? So if she got the surgery and then she didn't like it, hence that the doctor said, well, I give you a reduced the price. So this services, this eye doctor reduced the price by $400. So how do we record this? Same thing. Sales allowances is also control revenue accounts. So by recording it, we will debit sales allowance account for 400 and credit accounts receivable for 400. Same thing. This transaction reduces the revenue and current assets as well. So common mistakes. Students sometimes misclassify control revenue accounts such as the sales return and sales allowances as expenses. Like expenses, control revenue have normal debit side balance, right? We talk about sales return and sales allowances. We usually debit 200 and we debit the $400 what we just talked about, right? Return the glass and also dissatisfied with the surgery for 400. But control revenue representing a reduction of the revenue, whereas the expenses representing separate costs of generating revenue. So the essence of sales return and sales allowances is totally different from expenses, right? We talk about expenses means the cost or sacrifice of resources to generating certain portion of revenue or income. But sales allowance return is merely just meant reduction of what you sold, right? You sold $1,000 right now because something wrong with the partial of the 1,000. They want to return 200. Hence that merely sales return, it just means that the portion of their sale failed, right? Or you apologize or you compromise your sales because your customer is not satisfied. It has nothing to do with expenses. It itself is actually an equity account. If you have to say that, it's equity account that go against equity increases, which is on the debit side, right? Okay. And then now we talk about sales discount. Okay, I know we talk about the trade discount. I just don't want you to get confused. Trade discount is directly reduction of the list price, right? So for example, if you give trade discount for $20, then say the list price is $300, you give $20 trade discount, you can only record revenue of 280, right? Accounts receivable for 280. This trade discount is directly reduce the list price, and sales discount is actually something very interesting. It's actually trying to accelerating the customer's payment habits. Okay, so unlike trade discount, a sales discount representing a reduction not in the selling price of a product or goods, but in amount received from credit customer. If the collection occurs within a specific date, okay, a sales discount is intended to provide incentive for the customer to quickly make payments. So for example, this FYI offers a term of 2, 10, and 30. This means that if you pay within 10 days, you get 2% sales discount. If you don't get anything, if you pay, you have to pay full in 30 days, and you don't have any discount on $2,000 or customer pay on March 10th, which is within 10 days. Okay. So let me repeating what I just said about that. So there's a very professional word called 2-10 and 30. So what do we call? We don't say 2-10 and -30. The normal way we say it is 2-10 and 30. 2 means how much discount you want to give to the customer if they pay within 10 days. N means that full payment within 30 days. Okay, so if I write 4, 20, and 60, what that means that if you pay within 20 days, you get 4% discount on the sales amount or accounts receivable amount. But you need to make full payment. Okay, you have to pay everything that you owe within 60 days. Okay, so we can change more. So 5, 30, and 70 means that within 30 days, okay, you get 5%. If you pay me from point of sale to within 30 days, you get 5% discount by paying me fast. But you have to make the full payment within 70 days. Okay, so in current example is that EY offers the terms of 2, 10, and 30 on 2,000 old, and customer pays on March 10th, which is within 30 days, within 10 days. So what do we do? In journal entry, we will debit the cash that we actually will be received, and we will record some account called the sales discount to record the 2% discount that we were given, which is 2% multiple 2,000, which is $40. So in another word, the customer paid you within 10 days, and you promised the customer that if you pay me within 10 days, I give you 2% discount on the month you owe me. That means that the customer only need to pay you $19.60, right, to pay off the amount they owe. Okay, right? Okay, So that's why we debit cash only for 1960, and we debit another account called sales discount for $40 that you said it's okay to pay me 2% less if you pay me 10 within 10 days. And then we credit out all the amount that customer owes. Okay. So what is this? Same thing. The sales discount is also actually a control revenue account. Okay, it's a control revenue account, and reported with a total revenue in the. It's all when how do you present it? It's presenting with together the total revenue in the income statement, but with a negative balance. So next we want to show you. So just talk about this eye surgery. Okay, this eye doctor called FYI. They listing an income statement just to describing what happened to this specific customer. So first of all, they had a trade sale for what? For three. So the surgery and the product itself, the surgery was a 3,000, and they gave a trade discount for 600. Hence, the surgery is reported service revenue for 2,400. At the same time, on March 2nd, they made a sale, right, for the glass for $200. So that's what they sold. And then on March 4th, the customer is dissatisfied with the glass and want to return it. So this on the income statement, you less the sales return for 200, right? Because this we said is a control revenue account. And then I think on March 6th, the customer is very unsatisfied with the surgery, right? And the surgeon said, okay, I give you sales allowances for 400. Also, another revenue control revenue account. And the last thing, on March 31st, the company said, if you pay us within 10 days, we'll give you 2% discount, and you have to pay us in full within 30 days. So therefore, the customer did pay them within 10 days, right? Within 10 days, which is, I think, March 10th. So therefore, the customer enjoyed extra 40% discount on the amount they owe. And then, which is $2,000 they owe. Okay, so that gives them 40% discount. At the end, the net revenue is only 1,960. So let's look at what happened to the account. Okay. Okay. So at the beginning, you get the trade discount, right? Trade discount for 600, so 2,400 is your surgery revenue. You conduct the surgery and you got a surgery revenue. So you debit accounts receivable. So we'll look at accounts receivable account and credit revenue, right, for 2,400. That's March 1st. And March 2nd, you sell a pair of glass for same person. You get an accounts receivable for 200 and credit revenue for 200. And March 4th, they are not happy about the glass, hence that you say, okay, return to me the glass. So you report a sales return for debit and credit accounts receivable for 200, right? So that's what this is. And then March 5th, you have the person come to tell you that I'm not satisfied with my surgery. And the surgeon say, okay, give them some sales allowances, okay? Reduce the amount that they owe. So therefore you record sales allowances and credit accounts receivable for 400. Right now, if we just close the book right now, actually the customer only owes how much? $2,000, right? Because on the left hand side is 2,600 and on the right hand side is 600, so minus each other is $2,000. At the same time, the March 10th, the customer paid for for the cash. At the same time, remember the cash, right? But there's a sales discount for 2% of the month old, right? So 1960, and credit accounts receivable, right? But accounts receivable doesn't really need to taking care of this $40 at all, right? Accounts receivable just gonna be credited out at the day of the cash payment, right? So hence that accounts receivable is 0. On the other hand, if you look at the sales account, it record all these interactions: trade discount, sales return, sales allowances, sales discount. And this is actually net sales, 1960. Okay. With that being said, and then there's also end of the period adjustment for the contra revenue accounts, because we know, for example, in Christmas, we have a lot of sales because people like to give each other gifts, right? But over the after the December 31st, a new year comes, a lot of gifts actually people like to return or exchange or get the money back. So therefore, the companies, although made a lot of money, say $1 million for the Christmas sale, but in the end, in January, the net sale after calculating all this returns, discount, and allowances, maybe they at most really made 500,000. So that's very important for us to do year-end adjustments, that to make sure. So December 31st is considered how much this kind of sales return, sales allowances, and sales discount could happen. Okay. So the discussion about dealing with how a company report a contra revenues, we also need to estimate as well during the year. However, companies also must adjust for this account at the end of the year using adjusting entry. Okay, the revenue recognition standard requires a company to report revenue equals the amount of cash that a company is expected or entitled to receive. In other words, when December 31st, ideally, the number that you really report to the investor should be the money that you really can receive, or for the cash you are entitled to receive, meaning that should netting the unsatisfaction returns, right? So that's revenue reconciliation standard as well. We require a company to report the revenue, the real revenue, the net revenue. Hence, in order to report the net and real revenue, you need to estimate those sales returns, sales allowances, sales discounted. All right. Those expectations could change as new information comes and becomes available, right? It's changing all the time. Sometimes you estimate 20% gonna be returned, but maybe it's only 10%. Therefore, at the time of the year, a company must estimate an additional return, allowances, or discount that will occur or will occur in the following year as a result of sales transaction in the current year. But because the answers of the sales return, allowances, and discount is quite complicated, so we will not dive into the detailed journal entry for this class. But if you are taking, say, intermediate 1 class or advanced accounting class, we will talk about it in details. Okay, concept check. The effect of sales allowances will result in which of following? A, increase in net income. No, right? We said this allowances is the contra or opposite of revenue account, right? So an increase of net income, no, net income equals revenue minus expense, right? So if this account is reducing revenue, how can they increase net income? Of course, we're gonna reduce the net income, right? We just talk it. Okay. So the answer is B. Yeah. A sales allowance decrease sales revenue, right? Control account. And in the income statement, a sales allowance also decrease asset by decreasing balance of accounts receivable. Okay. Which following computation would be used to net revenue? We said net revenue is considering after considering sales discount and sales allowances, right? Hence that the true revenue should be equals total revenue minus sales discount minus allowances. Okay. Okay. So I'm just gonna this is the first part of this lecture. So I'm just cutting here, and then I see you in the next video. And next video we majorly deal with uncollectible accounts receivables. Okay.